Good morning, everyone. Welcome to the 2023 State of the Markets presentation. Before we begin, just two quick housekeeping items. Those of you joining us virtually, if you could please give a thumbs up or comment to make sure that our audio is working, that would be great. And then secondly, if anyone has to use the restroom during the presentation, the bathrooms are through those back doors in the middle of the hallway on the left. Our next annual upcoming event is our iShred event on Friday, May 12th from 11 a.m. to 1 p.m. We have arranged for a mobile shred truck to be on site, and you can safely and securely dispose of any unwanted personal or financial documents. We'll also have lunch provided. With that, we have our annual summer picnic, which will be on Thursday, August 3rd. So please save the date for that. And you can register for either of these events, either on our website under the events page, or feel free to call the office. We've also provided flyers with additional information on any of those upcoming events. And then with that, I would like to introduce Sean and have him talk.
Thank you, JP. So two people that I really appreciate in things like this, JP being able to get through his part and remembering all the dates, and Matt's group, because as this has expanded and we've gone from just maybe a few people in the room to a bigger audience, both present and virtually, having his background in technology has been a great help in spreading the message that we're trying to get out. Today, in addition to the state of the markets, we're going to have a lot of data and a lot of details. And our goal today is to make sure that that comes back to you as things that you can take away and use in your own financial plans and use with your friends and family, and be able to just hopefully have a little bit more peace about what's been going on in the past and where things might be going in the future. With iWealth, it's always been our primary objective to try and find out what your goals are so that we can create the plan around that. Things that go up and down in the markets don't change your goals, but we may need to adapt the plan at certain times. So there's times where we can stay the course, and there's times where we need to pivot and make an adaptation. So with JP, myself, and Brad, we're happy to sit down anytime, talk with you about that, and make sure that we can make sure that your plan is on track for what you want to have happen. Behind the scenes, we're always watching what's going on in the legislature and things like that. And so I wanted to cover a couple things that have happened recently. We had some really big legislative changes right at the end of 2022. And for the most part, they'll affect retirement plans. So while people are accumulating and saving into retirement plans through their businesses and small businesses, but it affects many people in the room, and it will also affect those that are coming up on retirement. And that is the change of the required minimum distribution age. So a lot of us remember when it was 70 and a half, and then it changed in 2019 to be age 72. Well, now right at the end of the year, they snuck in a change, and it's going to move to 73. So if you were going to turn and thought you were going to be starting your required minimum distributions this year, you get a year's worth of grace and you get to start next year. So later, that will also turn to age 75. So people that are born after 1960, they won't need to start those distributions until even a little later. Everybody realizes that some people are working longer in retirement and things like that. So it's a change that, again, is sometimes confusing because we've got maybe a number stuck in our head, but then now it's a moving target. So new people coming upon that information might be confused. Have them call us. We'd be happy to walk it through. The other parts are a much larger focus for retirement savings on Roths. So some of that Secure Act 2.0 that just got passed is really addressing trying to coach more people into using Roth savings in the future. So that might be something that you want to ask either JP or Brad or I about if you're not currently using them, if they're still available to you. And then I'd say one of the things that was kind of a disappointment legislatively was that Minnesota announced their giant surplus in 2022. And a lot of us thought that it was finally the catalyst to pass legislation that would stop the taxation of Social Security benefits for seniors in Minnesota. They didn't get the job done. The bill is still out there and still sitting in the House. So the way it works, federal taxes back in 1984, anybody remember who was president in 84? Reagan, did I hear? Yep. So he made it applicable that 50% of Social Security could be taxed. Later in 93, Bill Clinton moved it to 85% could be taxed. Minnesota followed in step with that, and they moved those numbers onto the Minnesota tax forms. So our hope would be that as they look at this surplus, they look at that and say, we're getting enough revenue, let's ease off on some of the people that maybe could use it in their own checkbooks instead of the government. So that are two, I think, of the biggest things that have occurred and we're keeping our eye on. But again, it's a moving target. Every day, every week, every month, there's new stuff coming out, and we'll try and keep track of it and make sure how it relates back to your financial plans. With that, I'd like to introduce our speaker. And so for the rest of the presentation, Brad Connors is going to be leading us through a lot of information. As president of iWealth, Brad has been advising individuals, corporations, and institutional investors since 1994. Brad is known for helping successful business owners achieve a self-managed company and to be financially independent outside of that business. The true outcome of his work is to remove the stress associated with things outside of the day-to-day work and to help them take care of their families and the causes that they care about. He does this by utilizing our virtual family office and connecting the clients to the right who's to get things done for them. Brad authored the book Fish Don't Clap, Planning for a Purposeful Retirement in 2014, and this was to give information to everybody that they need to find purpose in retirement. Brad's multiple 5-star reviewed book shines a light on all that he has learned in his 20-plus years of experience working with clients to define what vision they have for retirement. Helping other advisors grow their practice by sharing his experience on what is needed for a profitable and enjoyable business has also always been a key focus for Brad. He is involved in several business-focused mentor groups, which allow for the sharing of best practices and successful planning. Over the past several years, Brad has worked to design a client-facing website and a tool that allows advisors to articulate their value and conduct efficient and effective client meetings. This tool has evolved into a significant piece of technology that is now being used by several other advisors nationwide. Brad remains active within the community, including charitable giving, youth outreach, and community education and involvement. Brad has proudly sponsored the holiday food drive for the Waseca Area Neighborhood Service Center for the past 13 years and raised over $105,000 in funds to provide Christmas meals for local families. Funds raised have also positively impacted the backpack program, which provides weekly meals for local students. Brad has expanded his client reach to include a second office in Bloomington, Minnesota in 2020, and Brad and his wife Trudy have 2 children, and in his spare time enjoys golfing, fishing, and traveling with his family. With that, Brad.
All right. Thanks, Sean. So some exciting things today called financial planning, right? And stock market and those type of things. But raise your hands if in the last 15 months you've had an issue or felt insecure about the future when it comes to politics, when it comes to the stock market or the bond market? Raise your hands if you've had any of that anxiety over the last 15 months. A lot of us, right? A lot of us have. And that's the reality that we live in today. And I'm not going to sugarcoat that at all, but I want to give you some context of what we believe what happened last year and what we think might be happening this year. I will preface that I've always told, if we've sat down knee to knee, that I don't know any better than you do. But it's my job, it's our job at IWell to make sure that we're trying to surround ourselves with bright-minded individuals that will give us input and to give us some perspective on what's happening today in this market. But with that anxiety, I want you to take a look at what this is. 1970s headlines. Let me know if this sounds like anything today. Inflation continues to soar, up 11% a year. Milwaukee Journal, 1974. Stock market falls sharply on inflation and economic woes. Ford orders new steps to combat inflation. Economic in shambles. Inflation soars, stocks fall. Sound like today? Nixon resigns, Watergate crisis worsens. Carter criticized for lack of leadership. How about this? Congressional approval rating hits record low amid inflation. Sounds a lot like today, doesn't it? So much of the news cycle wants us to focus on that it's different this time. Sir John Templeton, you've heard me say this, the four most famous words is it's different this time when it comes to investing. It's not different. And I'm going to share some charts and some information with you that hopefully shed some lights on that. So some formalities. You guys know, I believe, that our broker-dealer is LPL Financial. We also have an RIA with Investment Centers of America Group. But there's our disclosures. And then cell phones. So I want your questions, by the way. So if you have questions, feel free to raise your hands or go ahead and write it down on the sheet that's in front of you. We'll have a spot at the end as well. But if you have a question, please do so. I want to know what you're thinking, because if you're thinking, somebody else is. But your cell phones, if you have those, if you could silence them, that'd be great. So let's take a look at the agenda for today. So how did stocks perform in 2022? And what drove the market performance in 2022? So what happened last year? And then where are we right now as we sit? And then what do the financial firms think about? If you've been coming to this year after year, you know that we show the slides that shows what the experts, so-called experts, the large companies think about what's going on in the markets. And we're going to do that for you again today and give you some perspective. So how did they perform in 2022? We know it's either thumbs up or thumbs down, and we all would put our thumbs down, right? We know that was a tough market last year, and we're going to talk about some reasons why. But take a look at this chart. This was last year, by the way. So 2022 S&P 500 target. S&P 500 is 500 large company stocks in the United States. It's an index of all those stocks put together. And you can see we got Morgan Stanley and UBS and Wells Fargo and Bank of America, RBC, and Goldman Sachs. These are large, really good firms. And it has the index value that they expected. And the group average on the bottom left was 4,867. But look at the left-hand side. Look at underneath here. Left-hand side. You'd see it's 3,839. We were down 19.44% in that basket of stocks last year. It's a really difficult year. But look at what they expected. They expected the stocks to go up and be at 48.67. There's a big disparity in what they thought happened and what really happened last year. By the way, I'll show you what the predictions are for next year. We'll see if we want to trust them or not, but I'll show you what they are. So what happened last year? This is a busy chart. I want you to take a look at this, though, because I want to walk us through kind of what went on. You know, we go back, and I'm going to show you a chart from 2021. It was a really good year in the markets in 2021. You can see where we started, but then in January, we had the CPI. That's inflation. CPI is the inflation indicator, and you see it rose by 7%. January 27th, we had GDP growth, so how fast our economy is growing at 6.9. We came up on the year. February 24th was the 1 year for the invasion of Ukraine, and we had that happen last year. March 16th was our first interest rate hike since 2018. We had went 4 years with no interest rate hikes, 3% mortgages. We have some bankers in the room, car loans, all those things were really low. And then you get to April 30th, we had the GDP actually shrink. So that quarter, we actually shrunk, meaning that we weren't putting out as many goods, and the economy was really starting to slow down. May 4th, the Fed rose 50 basis points, so 0.5%. June 10th, inflation sets 40-year record high. That's not all-time high, that's a 40-year record high. Again, getting back to it's different this time, but it had been 40 years. June 15th, the Fed rate hikes at 0.75. Then July 27th, another 75 basis points. Then you got July 30th, and you have GDP fall by 0.06. So we had 2 quarters. Some talking pundits on the TV would tell you that that means it's a recession. I can't tell you exactly. There's some formula of a group of people that sit down and tell us when we're in a recession. It's always backwards looking. We'll get into what this year looks like. But at this point, they have not claimed it's a recession. September 21st, another 75 basis points. And you can get this trend that's going on, these raises in the Fed. October of 30th, we have GDP actually rose, so now we started to rise. Yet another 75 on November 2nd, December 3rd, inflation rises 0.1, and then the Fed hikes 50 on December 14th. And then we've had a quarter already. So when we take a look at this chart, the line shows you what happened in the S&P 500. It shows you the 19% drop. This just gives you some perspective of all the stuff that we went through. But the number one thing that should be glaring at this chart should be the Fed. And that's the thing that everybody's paying attention to right now and looking at. And we're going to talk more about that as we try to look at 2023. But we've had a lot of raises in interest rates, and that's caused due to inflation, and we'll talk about where we think that's going. This is not different, but feels different. You got to go way back into the 70s to get there. So depending on when you were born or when you started investing in the market, this is the bond market. And what this shows is that the top line, typically the top line, but the black number is where it finished for the year, how bonds did for the year. And then you can see the red line is inner year. So up and down, everything changes throughout the year. But if you just look at this and don't get into granular and just look at the red dots at -2, -5, -7, and then the bars up here with the black, you will see that the bonds typically do pretty well. In fact, in this scenario, 42 out of the last 47 years, bonds were positive. But take a look at the dark black line from last year, -13. This is the Barclays Aggregate Bond Index. This is U.S. bond. It's a bunch of bonds put together. So all of a sudden, when you take a look at the stock market being down 19, the S&P 500, the bond market down 13, it felt different. You raised your hand because it does feel different because of what's going on. And the bond market is what helped cause that. We've been down 20% in the stock market. We've all remember back when COVID hit. Remember 08 and 09. A lot of us don't remember what happened with these bonds. Corporate earnings. So this is taking a look back at 2000, and you can see the negative corporate earnings. That's going through the COVID. And you can see some big negative numbers, -30, -5. And then the big corporate earnings on the flip side of that. You can see up 52, up 91, up 50. And that's just taking a look at the corporations in America and their earnings and what's been going on. And you can see that it's starting to come down as you look at this chart. And it goes out to Q3 of 2022 at 2.2%. So earnings are starting to come in line. We're at a point, and we're going to show this in the future a little bit here. We're at a point where bad news is good news when it comes to the market. The Fed wants to slow this economy down. And unemployment, normally you want no unemployment, 5% no unemployment. They want more unemployment. The Fed wants that. They want people to lose their job, and they want things to slow down. That's just the economics of where we're at today. And it's working. For a long time, the Fed said that it was transitory. It really wasn't. Inflation's been here longer, but it is working, and we'll show you some charts on things that are coming down. So the economy, let's take a look at a couple things. So GDP growth, that's the growth of the economy. I told you that the first 2 quarters of last year were negative. Q3 and Q4 were positive. So that's not good from the inflation standpoint. The Fed would like things to slow down. It is slowing, but again, it's not negative. The labor market, look at the unemployment rate. Guys, historically, 5% unemployment is no unemployment. Typically in America, we have 5% of the workforce that just doesn't work. And we're sitting here at 3.5, 3.7, but it's starting to go up. Inflation, 8.5, 9.1, 8.2, 7.1. You start to see the trend. It's high, but you start to see the trend that it's starting to come down, and we have some more on that in a minute. Consumer sentiment is basically how is Americans feeling? And by this chart, actually okay. And then housing. When you take a look at the housing indicator, the higher the number, the more housing starts, and you're starting to see that. And by the way, when we look at some inflation numbers, it lags. Housing lags anywhere from 9 months to a year before it hits the inflation numbers, and we'll take a look at what that looks like. CPI, so this will give you, this goes back to 1972, and this is basically looking at inflation. If you pay attention to this chart, and there's gray bars, those are recessions that we've had. And you can see, back in the 80s and the 70s, you can see the 08, 09, the Great Recession. But when you look at this in a general, take a look at that blue line on the far right-hand side and look at the CPI. That's inflation. But also take a look at the blue line as it's starting to come down. It's starting to come in line. But it also shows you when you look at this chart that we've been here before. You just have to get back to the 70s in order to see the spike that we've had with inflation. You can see that when you look at the headline, the 50-year average is 4%. In November 2022, we were at 7.1 and then 6.4. Again, trends are looking good for inflation to start to come back down. I love this chart because it's simple. It's red, green, or yellow. Red is not good, obviously. Yellow is caution, and green is good. This is taking a look at the CPI, and it's breaking down energy, food, core goods, and core services. What I want you to pay attention to is how this thing has evolved over the last several years. So 2021, 2022, look at the very top. See green, yellow, red, and now we're starting to see a couple boxes of yellow. And then go down that chart from the yellow and start to look. The first one is energy, bright green. We've seen at the pump, we've seen energy starting to come down. We feel that. Then take a look at food, started to come down. Trudy just told me this week eggs were back down. Whenever she just went and bought eggs, that they're starting to come back down. But food has started to come back down when you go to a grocery store. Core goods coming back down. But if you get to this bottom, this core services, look at shelter and rent. They're still red, but they're lagging. Just a Wall Street Journal article out this week talking about the buildup of these apartments in these inner cities and how rent roll-offs are starting to happen. So there's more supply and there's getting to be less demand, and they're starting to see softening coming in rents right now. We believe that that trend continues, which means that inflation trend continues to go down and will help this economy. At some point, the Fed has to hit the pause button. But I love the chart just because of the visual part of it. So where are we now? One of the companies that we work with is City National Rockdale, and they've been putting these together for years, and they call them the speedometers. But this is taking a look at economic indicators of different sectors of the market. This is November 2020. It's not last November, it's 2 Novembers ago. And when you take a look at this, again, green and yellow and red. Green's good, yellow caution, red's not so good. Bottom corner, geopolitical risk, almost is always red. We just don't know what's going to happen internationally with China and Russia and all those things going on. But you can see inflation was green, the bottom left-hand corner. And so pretty sporadic chart. But now let's go November 2021. That looks a lot better, doesn't it? November 2021, there's a lot of green on there. In fact, geopolitical risk was actually in the middle and was yellow. Then we take a look at this December. Obviously a lot different looking. A lot of red, a lot of yellow. Geopolitical risk is way up there. Inflation, you can see the bottom left again, is yellow. But the trend is starting to come back. Now, nobody knows exactly where these things are going, but we do want to take a look at what's happening with the rents, like we just talked about, what's happening with energy prices and food. You know, we're listening to the economists that we follow, and I'll give you some predictions of where they think things are going in the future. But that shows you where we're at today. So again, I just want to highlight, this is 2020, this is 2021, and then this is where we're at in 2022 as of December. So what are our headwinds? What are we facing that's going to potentially hurt this market? Inflation and rising yields. The market is just begging for the Fed to be done with their interest rate hikes. The Fed policy and being uncertain. They do dictate a little bit. They will put some messages out about what's happening, but no one knows for sure. At one point, we thought there'd be 2 raises this year, and now the market's built in 3. They also were talking about decreasing rates by the end of this year. We don't know where that's at. But that uncertainty is there. The recession. We'll talk about this, but one of the companies that we follow believes there's a 60% chance that we're in a recession this year. But they also feel that the S&P 500 is higher than when we started January 1st, which means that they feel that it's going to be a light recession. It's not an 08 or 09 in their mind, and we'll give you some numbers here to back that up. Corporate earnings is a headwind. They're starting to come down with the corporations. You saw that chart on where they were and what they're making now. And then geopolitical tensions. We don't know where we're at with Russia and Ukraine. I think they just lost 100,000 people. Unfortunately, it's horrible. But we don't know where that's going to go. And then what happens with the tensions in China as well. But there's also, guys, some tailwinds. There's some things that are going to help this market. Inflation is starting to come down. When you look at the charts, it's coming down, and that's a good thing. We don't think this is the 70s all over again. A more dovish Fed. The Fed have starting to let their feet off the gas, so to speak, and pumping the brakes. Falling U.S. dollar. We had a really strong dollar. That was back in September, October of last year, and that's starting to weaken, and that's good for goods and services. The interest rate cycle that we're in, we feel that we're getting towards the end of these raises that are happening, and hopefully we're there by the middle of this year. The seasonal effect that we have going on, and hopefully it feels pretty good outside today. And then China ends the lockdown. That's a key. They use a lot of goods and services that U.S. companies provide, and that lockdown is ending. That's a good thing for corporations as well. So S&P valuation. So this is how expensive stocks are. 25-year average. So the middle dotted line is 16.84 times earnings. And I've explained this before, and it's the easiest way for me to get my head around this. So I'm going to use this in context of a corporation. Let's say there's a dry cleaners uptown. There isn't one anymore. I have to go out of town to get my stuff dry cleaned. Dry cleaners uptown makes $100,000 of income, and we're going to walk in and buy that business. And maybe we sit down with our banker or something and say, what should we pay for the dry cleaners? They make $100,000. What should we pay? How many times that earnings should we pay? In history, would say 16 times, which means that we pay $1.6 million for that business. We collect our $100,000 a year, and that's what we would pay. That's the average of buying stocks in the market. When you look at September 30th, 2022, we're at 15 times earnings. Look at the chart behind it. Look at where we went up over one standard deviation. We were up in that 22 times earnings at one point. That means the stocks are more expensive. Stocks have started to come back down. In our mind, this is a tailwind. This is a good thing for the market that we have some value pricing on the equity market. So what are the forecasts for 2023 then? This is people's savings accounts and how they got their money. When you look at this chart on the left, you will see income, reduction in outlays, and fiscal support. Take a look at the fiscal support that we had back in 2020, the blue bar. And obviously that's turned off, and you can start to see that people's income that they had to put in extra savings has certainly slid down. But then if you look at the chart on the right, you can see where we were back in 2020 and where we are now. People still have money in their savings accounts, by and large, to continue to pay for these things that have came up for inflation. And it's part of the reason why the airports are busy, the Mall of America is busy, When you walk into these places, I was up at the cities yesterday and walked in for lunch, and that was busy. I mean, it just doesn't feel to me, when you look around and talk to the normal person that we talk to, it doesn't seem like it's a recession at this point. And people still have money to continue to spend. It is getting tighter. We recognize that. And you can see by the chart it is. But there's still money in people's savings accounts to continue to spend, and that's good for the economy. So real GDP, so growth, what it was previously, what the new is, and then unemployment rate. A couple things I want to point out here. Look at the unemployment rate on the far bottom, 4.4%, 3.7% in Q4 of 2022. The Fed wants to get to about 5%, which is historically where we're at. Some of the companies I listed earlier would argue we don't need to get to 5%, but it does need to go up. And we're starting to see that too. Another Wall Street Journal article in the last week or so talking about unemployment. Just today there was an article about the recruiters, the Zip recruiters and things like that are out there. Their stocks haven't did so well because they're not finding as many jobs out there for people. People are starting to soften a little bit, and unemployment will start to go up. So we'll see where this number goes. People have their own opinion of it, but it seems like things are starting to soften up. We're certainly seeing it in the tech space, and unfortunately we just see it in town with Itron that we heard about this week as well. So anyway, we believe that unemployment will start to go up, and then you take a look at GDP, which is how the growth is. They want us at about 2% for growth, and it looks like we're coming in line with that too. So these again, to us, would be tailwinds. These are things that we're looking forward to coming up. You might find this interesting. Total civilian population 65 and up. Look at the gray bar in the middle. So 33 million, and then you go to 2000, that's in 2000. 2010, you jump up to 39 million, 55 million, and 2030 we'll have 72 million. It also shows who's working. And it shows that there's 32% of the people aged 65 to 74 will be working in 2030. And then at the bottom it goes wants versus needs. So in the gray bar, the needs, 27% are going to do it because they want to buy extra. I really like to look at the bottom on the wants. Stay active and involved. 52% of these people are going to work because they want to stay active and involved. I wrote the book Fish Don't Clap because we helped too many clients retire and they shouldn't have, because they weren't ready yet for that next phase of life. And that's exactly what this is pointing to. Stay active, enjoy working, job opportunity, try a new career. I don't expect everybody to run out and get a job tomorrow because you see this. All I'm saying is that I think we're going to continue to stay very active as we age and get older. And all of a sudden the new, 30 is 40 and the new 40 is 50. We've all kind of, as we get older, we like to play those games with our head, right? And where we're at. Time and diversification, volatility. So the green bar is the S&P 500. That's 500 large company stocks. And then you've got bonds in the blue bar, and the gray bar is a 50-50 portfolio. So if you put 50% in stocks and 50% in bonds, you can see what those returns are, but it's rolling 5 years, rolling 10 years, 20, and then 1 year. And guys, this is going back to 1950. A couple things that are really important. Just look at the 50-50. Forget about being all in stocks or all in bonds. Just if you just put 50-50, rolling 5-year periods, you can see it's positive 1% and 21%. So there hasn't been a rolling 5-year period where you had half your money in stocks and half your money in bonds where you were negative in a 5-year period. And that's behavioral finance when it comes to investing. That's acting correctly when this market goes down and not panicking and staying in that investment. And then you take a look at a 10-year, 2 to 16, and then 5 to 14 in any 20-year period. Just 50% stocks, 50% bonds. But we also know how painful that was last year. One was down 13 and one was down 19. Really tough year last year. Same chart as the bonds, but this is stocks. A lot more volatility. If you look at the red dots again, that's where it hit sometime during the year. If you look at the black dot, that's where it finished for the year. So if you go all the way over to the right, you'll be able to see the minus 19 is where we were at last year. You can see we were down 25%, finished 19. But look at the gray bars below the graph, negative, and look at the gray bars above the graph. Again, S&P 500, 32 out of the last 43 in this chart have been positive. And when you take a look at the average inter-year drop, it's 14% where we drop. So we had a really good January, we had a really bad February. We'll see what March brings for us in 2023. But what this tells me is it gives me perspective for the future on taking a look at the stocks and bonds in our portfolio and keeping that longer term perspective, knowing that we have this volatility that's in the market. 60-40 returns. What that means is 60% in stocks, 40% in bonds, similar to the 50-50 I just got done talking about. The green bar is how much of the return came from stocks. The darker bar is how much is from the fixed income or bonds, and then you can see the total year rate of return. Take a look at last year's performance with the minus 16 on that 60-40. This is going back to 1950, but once again, I point to the chart and just look below the line and look above the line. Again, history will tell us we're going to be fine. But really, really tough last year. So I just said behave correctly, and I don't mean that in a childlike way for my kids. But when it comes to investing, it's really important that you pay attention to the long term. There's two different types of phases in life. There's an accumulation phase, and if you're not retired, that's where you're at. You're just accumulating wealth. And then there's a distribution phase of life. And if you're retired, that's taking money out of the account. And that's a whole different set of issues than it is just accumulating. But let's just focus on accumulating for a second. When you take a look at this chart, you can see the S&P 500, 10 years from 2012 to 2021 was up 16%. So if you had your money in the S&P 500 index, that's how much you were up. And then if you took the small cap, you're up 13%. But go to the orange bar. The average investor did 8.7. So why is the average investor doing 8.7 when the stocks are doing 16? Because they're not behaving correctly. And I'll submit that that's why a lot of our clients work with us, so that we can help them. We can help them have perspective like hopefully you're getting today on this market. Now, if we go to the other phase of life and we talk about distribution phase, it's a lot different. And the reason why the distribution phase is so different is because sequence of returns matter. When you first retire and you start to withdraw and live off of those accounts, if those first several years are negative in the market, it's going to put you on a path that's not very favorable for the long term. And we have all kinds of charts to be able to go through this with you. So when that change happens, when somebody has that sequence of returns happening, meaning they're going to go to the distribution phase of life, it's really important that you have a plan put in place for it. But this chart, I wanted to share this with you, and this chart has been true for 28 years that I've been in this business with the way the average investor invests versus what the market does. All right, so let's get back to these experts and what they think for this year. So we have Morgan Stanley, UBS, Wells Fargo, B of A, RBC again, and Goldman Sachs again. The group average is 3,800. I wrote some notes up here on the top. So on 12/31 of 22, we finished at 3,839. Look at the average, 3,800. Now you do have in there, you have a 4,000, you have a 3,900. The second bullet point is on 2/28, we're at 3,970. So we're up where we started the year. I go back to these guys that thought we were going to be at 4,200 or so last year. You take a look at the 22 expectations, 4,867, that was last year. And we finished the year at 3,839. All this does is confuse me. When I'm trying to figure out what's the market going to do in a one-year period, all it does is confuse me. Because they expected a really good year coming off of 2021 in 2022, and it didn't happen. Now they're expecting a flat year this year. So it's really difficult to get your head around it unless you go back and you look at history, which is what we've been talking about today. This number I've showed you before, bottom, October 31st, 1994 is when I started in this business. S&P 500 was at 472. That's the index, 472, and it's almost at 4,000 today. It's 10 times in 28 years. We've been through all kinds of things in that 28 years. We've been through the dot-com crash, we've been through wars, we've been through COVID, we've been through all kinds of stuff. And if you woke up today 28 years later and had your money in the S&P 500, it's went 10 times. Again, it's just important to make sure that you're disciplined and you're at least talking to somebody that's going to be able to help you to be able to understand these markets and help you guys as you go forward. So I wanted to open this up for some questions you have, but before I do that, so if you have some questions, I'll ask in just a second. I wanted to make sure that I introduced a couple people that we missed. So Zion is in the back of the room. Zion's with Minnesota State Mankato, and she's a junior, correct, in the finance department. So I go to Mankato once a year and talk to those students. I just believe in helping the community and love doing that. And her track might be more managing money, so someday maybe her name will be on your statement as a portfolio manager or something like that. But I wanted to say thank you for being here. I appreciate that. You bet. And then we also have Matt Potter. So Matt's been with us for a year. Matt's our COO. I think a lot of you know Matt. Matt's in the back. And then, of course, Patty. These things, I mean, you wouldn't have food today if it's not for Patty and everybody else around, and Michelle and the whole team at iWealth. But Patty's here, and Matt, and then JP and Sean, and then Zion. So I wanted to make sure that I thank them too. Questions about today? Just raise your hand. Anybody have a question about today? Gary.
I didn't hear anything, you talk about anything about personal debt. How is that going to factor into this going forward, or is that a non-entity?
Yeah, so the question is, what about personal debt? And is that going to factor going forward? I believe it will factor, and it is going up, Gary. Just like the personal savings has started to come down, personal debt, credit card debt is starting to go up. I had last night I had talked to a client that was looking at a loan, and the loan for the vehicle was at 6.9%. When the loans start to become 30-year mortgages are at 6.9. So all that stuff is going to factor in. But yeah, as the credit card debt and you start to have people that can't pay their bills, that's going to affect things. Does it negatively affect in the short term? Nobody knows that for sure, but it's part of the equation for sure. It's a good question too. Yeah.
All last fall we've been hearing rumors of stock market crashing. I'm hearing more of that now. So when that happens, and I think it's going to happen at some point, what do you people do? How do you respond to that crash?
Yeah, it's a good question. So the question is, what about the stock market crashing? He's hearing rumors of that and those type of things. So back in 1928, stock market crash, if you could have held on to those assets and not sold them, for the most part, you'd have did very, very well. And so put your head under the pillow is one of the answers. But we work with advisors. We work with teams of people that help. And what I mean by that is if they believe that they need to pull back on an investment or overweight bonds or things like that, they will. We don't believe a stock market crash is here. We believe a recession might happen, but that does not equate to a crash. In fact, some people would argue that they think we're in a recession right now. And by the time they say, hey, we're in a recession, the market's already ahead of it. And so I don't believe in market timing. I'll go back to the slide of the 472 that the S&P was in 1994 in October, and at 4,000 a day roughly, and say that you just have to be able to, if you don't need those funds to live on today, and you have your money in different places that you can withdraw from if the market does go down, if I'm wrong. But we know that the market always sets an all-time high. It always does. Its question is how long was it going to take, and can we wait it out?
Well, can you wait it out, or can you live long enough in many cases?
Yeah, and you're right, and most of our clients, we're not dollar cost averaging out of the market to send them a check every month. We'll have that in either a guaranteed account of some sort, or we'll have it in a safe account, and that's what they're going to live off. So a lot of our clients will have 1 to 3 years of income that is set in a separate bucket in case the market goes down, so we don't have to sell those shares and let things come back. Yeah. It's a good question, and you're right. And you're going to hear stuff about gold. If we get in a recession, there'll be gold commercials, and all that stuff will show up too. But what's interesting about where we're at today, and again, go to the mall or go out to eat or go to an airport, just doesn't feel like that. It's just people still have money, and they're maybe it's post-COVID and they want to get out and travel or whatever that is, but it just doesn't feel like everybody's destitute and sitting at home and losing their jobs left and right and things like that. Now, I understand if it's you that lost your job or heard the news this week, then all of a sudden that feels different to you. I get that. Yeah.
Yeah, but what you're saying is you're relying on people at the Mall of America airports. Most of these people don't know anything. So you can't base anything on their reaction to the economy.
Yeah, but good question. So question is, what about relying on these people at the mall and those type of things? What are those people doing? They're buying things. They're shopping. They're using airlines. Those are companies that we invest in every day. We brush our teeth. We go to the grocery store. We go to movies. We have Netflix on our TV. We have Verizon. We have different things. And so if people have money to spend on those things, that's typically good for stocks.
Well, a lot of them are just increasing their credit card bills.
Some are. And that's back to Gary's conversation about how does that affect people as they're doing that. Yep, some are. But also the chart that I showed you, and these are good questions, by the way, but also the chart I showed you shows that there's still more savings than pre-pandemic that people have in their savings account. But that is dwindling. Yep. You had a question?
Yeah, you showed that 70s thing, they're going, the different things that went from back in the 70s.
Yeah.
One thing that I do know is that back then, you had got a home mortgage. You had interest rates up to 14%.
Right.
Yeah. So I think that's a big difference too. And the credit card debt, if I look at it right, if people don't make it and they start losing some of their assets, even their home or so forth, that means to be more homes available, which eventually bring down prices.
Right.
Kind of what they're looking at.
Yeah, and hopefully they don't lose their home. But yeah, as demand slows down, as interest rates are higher. So the question was about, look at the 70s. And we have a lot of clients in that situation where they were borrowing money to buy houses in the 70s and paying 14, 16, 18%. And now they have cash and they're getting nothing. Well, now starting to get something on 4%, let's say at a bank or something like that. And I've reminded people that are out in the market that are looking at rates now that are younger saying, shoot, it would have been 3.5%. Now it's at 6%. I'm not buying a house. And I remind them of the generation that paid 16 and 18%, and they still were buying houses. So it's not like because interest rates went from 3 to 6, everything's just going to stop. But it's definitely slowing down, and that plays into our favor with the Fed starting to slow down and inflation starting to back up a little bit. Yep, good comment. Other questions? Yeah.
How solid are these companies that are managing the annuities that we're growing income on annuities in our retirement?
Yeah, so the question is, how solid are the companies that the annuity payments are coming to? I'm going to talk in general terms, obviously, down, but when you look at the annuity companies, they went through a deal back in 08 or 09 where they had to recapitalize and reserve for losses. And so you can look at annuities and look at their rating agency on what the ratings have them at, but in general, very solid, especially in light of maybe where they were at 15 or 20 years ago where they had to reserve for losses on that standpoint. Remember, a lot of these new annuity companies are using indexes, and they're using that index to offset that cost that they have if all of a sudden they have to pay it out. Secondly, a lot of them pay it out on a long-term basis. And so they have a lump sum of your assets, they put in an account, and they're guaranteeing you an income stream for the future, which means that they can plan for that income stream over time with different tools that they have, which is way above my league when it comes to reserving. But the bottom line is they're very solid, but we can look at individual companies, get ratings and things like that too. Yeah. And it would be a concern if part of my income was based upon annuity. You want to make sure you're with a very good, reputable company that's paying you that guaranteed income stream for life. Yep. Do you have a question?
Yeah, I've always been curious about inflation. they say 6, 8, 10%, whatever. But then you can go to the grocery store and you can find many items that have doubled or tripled. So that's 200, 300%. So how do they figure that 10% or 8%?
Yeah, it's a combination of everything, but it's weighted as well. And so the weighting is even higher on rents and on housing than it is maybe on energy or food. But it's a combination of all those things. And you're right, a lot of economists will watch Walmart. They'll watch Walmart and see what Walmart's doing with their prices to see what's going on in the economy. As Walmart starts to reduce their prices, I mean, they're just so large and they're worldwide that they'll watch that. But you are right, and then what they're starting to see is they'll see a trend where instead of getting this premium cut of meat, they'll buy this cut of meat. Or instead of buying steak, they're buying pork or whatever. They'll start to buy something less expensive, and they'll track that. But when it comes to the CPI and inflation in general, it's all those different categories, and then it's weighted based upon those different sectors that I have there. And it's the formula that they have that they put it together. And that's why economists, if you watch the news, which I don't any longer, but the economists will, some economists will argue that the Fed should be looking farther out on rents because it's such a big part of the CPI and the inflation index that they're not taking into effect that it's going to be 6 months before we start to see this effect of the 75, 75, 75, 50 that we got for rate increases last year.
So what I hear you saying then is that groceries might be up 200%, but rent, which takes more of your money, might only be up 2%.
Potentially. Yeah. It's all in their magic formula that the government has for it. So, yeah. Bruce.
Question on mutual funds.
Yep.
When I first started investing, I mean, that was the deal. I mean, you're so much more diversified. We're buying different stocks. And if you look at mutual funds, they pretty much all own the same stocks and bonds anyway. So I'm getting a lot of calls on people saying that, get away from mutual funds and go into more just buying stocks and bonds and kind of create your own portfolio.
Mm-hmm.
What's your feeling on mutual funds versus that?
Yeah, so mutual funds, the question is, what about mutual funds and has it changed if they're all buying kind of the same stock? Mutual funds have been around since 1924. A mutual fund is a basket of stocks or a basket of bonds or a basket of stocks and bonds. And there's never been an open-end mutual fund to ever go broke since 1924 because if one stock in there goes broke, there's 99 other stocks to hold it up. But back to your question, like, have they ran their course or whatever? I think the answer is no, in my opinion. There are large cap stocks, mid cap, and small cap stocks. And what we find when we're meeting with clients is they'll bring in a couple 401k statements and other investment statements, and we'll put them all together and look at it. And you are right from a standpoint that a lot of them are buying the same underlying stocks inside of that basket, and we call it overlap. And they're collecting names on a statement, and they'll have 20 different names, but if 15 of them are buying the same stock, to your point, they should just buy the stocks, and they're not truly diversified. So I think if you truly bought a small cap and a mid cap and a large cap, and then you got value and growth, I think you can get great diversification from mutual funds. ETFs are similar to mutual funds, exchange traded funds, which is mimicking the indexes. They're here to stay too, but I think they're a really good investment tool, my opinion. Yeah, but we will have clients that own ETFs, clients that own stocks, clients that own individual bonds. It just really depends on their preference. You'll hear some arguments that if you just buy individual stocks, that maybe it's less expensive than if you buy a mutual fund, or if you buy an ETF, it's less expensive. So all those things have to play into that conversation on what you should own, in my opinion, when you put together a portfolio. Yeah, it's a good question. Anything else? All right. So a couple things here. So steps you should take. Number one, make good decisions and behave correctly. Let common sense win and not emotion. Through last year, even with bonds down 13 and the S&P down 19, I continue to tell my team and my clients that I met with, I don't feel it's different. I have no anxiety over this market. If you don't need these funds today to live on, or to buy your house, or to buy your next car, and it's long-term money, I have no anxiety. Not over my own assets, not over the money that we're managing for clients. That helps me put me in perspective to behave correctly and not make irrational decisions. Getting back to that. And if you have those thoughts, that's exactly why you work with somebody like us, so that we can at least talk to you about them and give you some history and some charts. Number 2, keep us informed of the important changes and tell us about any investment concerns you have, so communicate with us. We want to meet with you. We need to meet with you and continue to have those conversations. Make sure your essential documents are up to date. Guys, 23% of the clients we work with have their wills done. That's it. 23%. We need to make sure our wills are done, our estate planning documents are done. We don't do them. We'll help have the conversation with you on things to get you ready, and then you need to see a professional to get it done. But only 23%. We need to do better work at continuing to remind our clients that we need to get you in front of somebody so you can get those documents done. Steps for us to take. We need to keep you informed through communication. We have a weekly email that we send out. We do things like this. There's some things on social media that we put out. And if you're not hearing enough or have some questions, then please reach out to us. Number 2, manage investments according to your personalized strategy. Back to what Bruce was saying. Is it mutual funds? Is it ETFs? Is it annuities? Is it stocks? Like, what should that strategy look like, and what's the risk look like for you? That's our job to help you with that. Our job to help you with sequence of returns on what bucket to spend for that next paycheck that's coming out. And then remain abreast of the economic factors and adjust accordingly. We have 2 or 3 economists that we talk to, that we listen to, that we watch. We don't worship them. We understand the economists all got it wrong last year. But we're trying to get our good opinions so that we can help our clients make smart decisions with their money. So with that, I just want to say one thing. As you guys might know or might not know, we're on Facebook Live today as well. So if you're on Facebook, if you have any questions, put them in there. We can get back to you. If you were able to hear us and maybe not agree with me, but hear us, give us a thumbs up. Let us know that you enjoyed the presentation. We continue to do this every year and help our clients. But with that, thank you guys so much, and I appreciate it, and have a good rest of your day.